Good afternoon, everybody. Welcome back to the weekly market analysis from the week ending November 11th. Happy Veterans Day to all of you in the United States, and happy Armistice Day to those of you around the world who take the time today to recognize the contributions of the armed services. I thank you for your service, those of you who have served. The markets were open today. This is one of those days where, even though it is a holiday, observed holiday, we actually did have a market or an open market today in the United States. And this today we're going to be talking about how we've had a series of breakdowns and also breakouts of significance. And what we're all asking and wondering right now is this the beginning of the turn in Fed policy? And are we seeing the first rumblings of the coming change in macro conditions, which will lead to maybe perhaps a new bull market in stocks, um, and the end of dollar strength, and the end of high yields in the bond market. And I'm going to try to look at a lot of these different things. I have kind of a unfolding thesis regarding where the markets are at, including the dollar. Many of you guys know I've been a dollar bull for a long time now. It was back kind of in October of last year once we got above and retested support on the way up, where I became a dollar bull after having been a dollar bear, honestly getting to it a little too late, and then continuing to double down on dollar on being a dollar bear. And so once we had this kind of double bottom and we got above our previous March 2021 high, closed above it and continued up, that was my clue that I needed to change directions. And so I've been really trying here in 2022 to really pay attention to the macro backdrop, to try to see kind of how to read the central banks and how to read both fiscal and monetary policy. Trying to learn a lot. Trying to learn from my mistakes of just believing that because I think the dollar needed to go down back here, that it must continue to go down, and trying to always be mindful of the fact that even though my bias is, even with these breakdowns, is still ultimately to the upside in the long term, or in the mid to long term, that doesn't mean that the dollar will. And full disclosure, those of you who do follow me a little bit more closely, I exited all of my any remaining dollar trades once we broke this. Let me turn the moving averages off for a second. Once we broke this ascending trend line, any remaining dollar trades that I was in that I hadn't taken profits in were closed out. Most of my dollar trades were closed out on these bounces, or on this particular bounce. Many of you know, if you've been following me, just for full disclosure, many of you know that I was pretty adamant about in this area in late September that there was an exhaustion signal on the dollar, and that was the spot where on the euro, the British pound, and whatnot, you want to trim, at the very least trim, if not fully take profits, because you would expect after an exhaustion signal that you're going to get some pretty extensive consolidation. And we did get that. So once we bounced up here and we kind of started to roll over, I took that as the opportunity to close most of my trades. So I took a little bit of profit here, closed most of my trades here, took a little nibble to the upside in late October, and then that obviously ended up getting stopped out, and then closed out as soon as we broke this trend line. So in the near term, I do expect the dollar to either move sideways or down further from this. I actually don't think that we're going to see that much more downside and I'll this is going to take me a minute to try to explain kind of my unfolding view of where the markets are at right now. Because obviously the big news of the week was the CPI, which actually came in lower than what was expected, just in general, and then especially in core inflation. And that decline in core inflation is what really got the markets excited. And so the dollar had already been kind of consolidating sideways, and we've been seeing strength in the euro specifically, which is more than 50% weighted in the DXY basket. So the dollar has been getting a bit heavy here, but obviously the big CPI release really knocked this thing down. It looked like what was going to happen was we were going to catch this support here, and we were going to come back up and resume back up. But obviously the CPI led to a big down day, big breakdown. We were over about 2.25% down in the DXY. And so we've got the 200-day moving average here at 104,782. You can see this pink line. That'll be the kind of the first place to watch to see if it'll catch support there. We also have maybe a horizontal level if we kind of look around 105.5. So that's going to be a place where, let's see, right about there. It's going to be a place where you can actually see the 200-day moving averages coming up to that level. So I'm going to, my guess, there's a couple things I think just on this price action, you should expect that the dollar's going to get a bit of a bounce. The question is what's going to happen on that bounce, and I suspect because like those of you who have been following me, I basically like marked a line that looked something like this, and I thought it was going to go up from there, just given the macro backdrop as I saw it. But obviously with the breakdown, now what I'm looking at is I'm looking for a bounce to come up near the 100-day moving average, and then a consolidation that's going to come at least into late November and into December. And I totally wouldn't be surprised to see it come to this horizontal level right as the 200-day moving average is converging with that horizontal level. So that's going to be something I'm watching for. But again, like I think what's concerning me from a positioning standpoint is that as soon as the CPI hit, a lot of people just really started to pile into the euro, and it doesn't mean that the euro is it doesn't mean that the dollar is going to just shoot right back up and go to new all-time high or new highs for the year, but it does typically mean that when it gets crowded that you're going to see that snapback. And so you should just expect that. But the question is, like I said, what's going to happen once it does do that? And so my expectation is something kind of like that. And I do expect that there will be either sideways or slightly down moves in the dollar at least until December, which is when I think some things are going to change and cause a little bit of some market repricing. And I'll get into that in just a moment. But that's kind of the look on the dollar for right now. You want to be really careful chasing if you're going to take short dollar trades. You really want to wait for that retest of one of those levels, either a horizontal level somewhere between 109 and 110, or a retest specifically of the 100-day moving average. But we did get that over the last 2 weeks. We've gotten a breakdown below the 50-day again, and then a really significant breakdown below the 100-day moving average, which is that yellow line. The other thing I wanted to talk about briefly here is the 10-year Treasury yield. Just as a barometer, obviously you could look at lots of different Treasury bond yields, but obviously we look at the 10-year here. And we broke this trend line, which had been kind of slowly getting adjusted periodically. It was kind of like this, and then we got a breakdown, and then we made a new all-time high per my own TA rules. I moved it here. And then I honestly, on this channel, I debated on whether I should keep it here or whether I should move it down to this wick. I ended up moving it down to the wick. No chance now. It's a clear, decisive breakdown. And so we actually made, I'm going to delete that. We actually made the lower low here compared to back in late October. So technically speaking, what we should be doing TA wise is trying to look for some market symmetry here. Doesn't look like we're going to get the symmetry that I was kind of hoping for here. But maybe what we could do is put that trend line right there, because that's going to be kind of the breakout trend line. This could consolidate. I don't know. We'll see if we could do it maybe right here. Maybe that'll work a little bit better. If we clone this, um, we get this right there. Yeah, that looks like it works. So that's something to watch out for. I'm not betting the house on this channel to the downside. I do want to call out though that I mean, just look across. We've already had a couple of instances where price came significantly below, say, the 50-day moving average. But as far as a mean reversion, the 50-day moving average is a really good place to start, and we did successfully hold support on the 50-day moving average. I do want to call that out. So I don't think this is the time specifically right now where you have to where you should instantly begin buying the 10-year treasury bond, or like what is it, the IEF ETF, or even buying TLT. You don't just jump in right away. I know there's a lot of talk about, the most money is made on the turn, specifically on the turn in the trend, but it's so risky, and I feel like, 9 times out of 10 you're not gonna be able to pick the top. And I think the thing that worries me both on the dollar and on yields is that everyone is like immediately crowding into this like it's the top. And I would say when the consensus is so certain, the consensus honestly is not all is usually wrong. Um, and so I think you just need to be cautious as you approach that. Now when it comes to the yields, I just want to call out like what's happened on two occasions. And I'm gonna, again, full disclosure, I was one of the people who, right up here, I was saying, oh, I don't think yields are gonna go. Oops, I don't think yields are gonna go higher than 2. If they got close to 2, I thought that would trigger a reaction, um, but I did expect it to get to 2, but not much higher than 2. And over here, we got this long consolidation. I mean, this consolidated for, nearly 6 whole months before, starting to move back up. And the yields didn't make a new high, not even just on a closing basis, but on a wick basis. We didn't even get a new high from this little wick peak in March of 2021 until January of 2022. So this year. And, so that was a really long consolidation. And then we had a similar situation happen in the summer this year, when everybody was calling the lows in June, which, by the way, I'd like to pat myself on the back if I could for a moment, that, the June lows were not actually the lows as far as like crypto was concerned, and even equities to some degree. A lot of people were calling topping yields here in June. And I remember saying down here on August 1st that we were going to see another push higher in yields. Now, all of my goals for yields and the dollar have been met, but down here on August 1st, I said, you could check my Twitter, you could check my videos from around that time. I said we were going to get another push up to a new high, to a yearly high, at least one push. And so we got that. So, as far as my goals are concerned, we've met my goals. The same thing on the DXY. My original goal was that we were going to see somewhere between 108 and 115, and we obviously got into that. So my goals are met, but obviously I just want to be fluid and aware of what's happening on all this. I don't think that we should just so lightly how can I say? I don't think we should so quickly and easily kind of like push off the possibility that this is just another consolidation that happened, or that is similar to our June through August consolidation on yields, or like the March 2021 to August 2021 consolidation, that eventually, both of which saw new highs, new yearly highs, or getting to new highs eventually. So I don't think we should, discount that possibility. And here's where we get to kind of why I've been really trying to find, because you can find on the Federal Reserve, Atlanta Fed, and the Cleveland Fed websites, you can find the metrics for median CPI, trimmed mean CPI, and sticky CPI. I've been trying to find a lot of those specific numbers for some time. Um, and I just haven't had time to get around to plugging those specific numbers and over the last approximately 2 years into my spreadsheet here. But there's some things I want to call out, and I know that there's some people who have been calling this out. So I'm not new in this and I'm not first in this, but I wanted to specifically highlight a couple of spots on the month over month annualized aspects where if you look at the month that just happened here, the report for October, which we just got, and you see the significant month over month annualized decline on a rate of change basis, over 200 basis points, and in some cases, like in the case of sticky CPI, almost 400 basis points of a decrease in the month over month rate of change. So we saw a very similar behavior back in July, where in the July report, which we got in August, which showed again that similar steep decline, which everyone's getting really excited about because it came in below expectation, and then on a month over month annualized basis came in so much lower. And so the markets get really excited, like this means that, oh, we're going to come down to that level again, like we're going to come down at that same rate again. And that's just not likely. If you just look at the rate of change, you know, like that's a pretty significant like expectation. And the best way to see that is to look at the 3-month annualized in all of these situations, because that's going to kind of clean up this varying change that happens on a month over month basis, because there is a pretty significant difference between coming in at a 0.7 or coming in at a 0.5, at least if you annualize that. So looking at the 3-month annualized is really, really important. And what you see is, at best, in the case of, say, trimmed mean CPI, we have come down over the previous few months on a 3-month annualized basis. But median CPI is actually up. It's been steady and up versus the last 6 months or so, but for 3 months in a row on a 3-month annualized basis, we've read at 7.6. And then on sticky CPI, we've held at 6.8% 3-month annualized for, this is now 4 months in a row. And so at best, you could say that inflation is moderating and stabilizing, but it's not really coming down. And I want to return back to this whole idea of the rate of change and how stark of a contrast that is versus the previous month, just like what happened in the July report. Because I think what is ultimately going to happen is you're going to get, and it's easy to see based on if you go to the Atlanta Fed website and you look at the 3-month annualized and then the 1-month annualized report on the chart, you can actually see that the purple line oscillates along the blue line. So the purple line is the 1-month annualized, and then the blue line is the 3-month annualized. And you see that it kind of moderates around and returns back to that blue line. And so I think what the problem is that we have now is that the market is expecting the rate of change to come down like it did last time in this last report. But the more likely outcome is that it's going to mean revert back up to the blue line, and that's going to show an increase. And I suspect, and this is kind of my working thesis as of right now. And here's looking at median and trim mean CPI along with CPI and core CPI, and on the year-over-year percentage change. And again, like it's flattening. It's come down a little bit, but if you look at the the core CPI, it's more just like flat, and it looks like trimmed mean and median CPI are just leveling off. So again, my working thesis right now is that this data release for the October CPI is providing some breathing space for the markets, for the dollar to come down, for yields to come down. But then I think the market is going to become complacent about this expectation about lowered inflation, and that's going to mean a surprise when it comes to the next CPI print, and then of course the Fed meeting, which the CPI print for next month, which is released in December, is released December 13th, and then the Fed meeting starts that same day, and then the rate decision happens on the 14th, the next day. And I think the market is being set up right now for some huge disappointment. And actually I should have had this up, rate hike odds. And just pulling up the rate hike odds on the CME Fed Watch tool, what we've got right now is, and I tweeted about this, we've got currently an 83% chance of only a 50 basis point hike. And you actually, when you pull it up on the chart, and I don't have the chart up right now, but when you pull it up on the chart, the market is back to expecting 50 basis points of cuts in 2023 after reaching a peak sometime between March and May. And so the market has interpreted this lowered inflation reading as an expectation that not just that inflation is going to come down and so the Fed can stop raising, but that the Fed will actually start cutting. And then of course that's where you incorporate other economic data like the jobs numbers and things like that. So the market is going to be expecting, especially now that the election is over or almost over, the market is expecting that the jobs number is going to come in again with a lower jobs print, either a lower jobs print or with a higher unemployment rate, or both potentially. And the market is going to take that as, again, further signs that the Fed will decrease its the extent to which it's going to raise rates, decrease the speed, and then maybe pause at a lower level than expected. And then again, the market is still expecting that the Fed's going to cut. And so all of that to say, we had just some really huge moves in the S&P yesterday. We were up over 5.5%. The NASDAQ was up, which has been lagging, by the way. The NASDAQ was way below its June lows, like pretty significantly below its June lows. And so obviously it has the most to catch up. And so naturally you see the NASDAQ up over 7.5%. The Dow yesterday was up. What's crazy is the Dow was up in terms of percentage, was only up half as much as the NASDAQ, but also, I mean, after having made lower lows, the Dow has been on a tear. In fact, if you go from the top, from the market peak, the Dow has closed now to where it's only down 8.5, almost not even 8.5% for the year. And then speaking of markets, I'll just start with the Dow right now. The Dow got all of its, in the last couple of weeks, has gotten all of its significant technical levels broken out from. So we broke the 50-day, we broke the 100-day, we came above the 200-day, came back below, got back above, got rejected at this descending trend line, which is marking the downtrend, and then retested the 200-day, which is what you want to see. This is where, this would have, I mean, people are getting really excited right there, and they should be, from a technical standpoint. And then we got that huge day yesterday, which helped us to break through the descending trend line, and then obviously came down a little bit today, but ended up closing basically just minus 27 points, which is nothing on the Dow, honestly, because we're talking about being up in the 30,000s. So the Dow is in the best shape as far as technicals go. The S&P 500 still below its trend line, its major trend line, and still below its 200-day, but we got basically a move above both the 50 and the 100-day moving averages, and above a really significant horizontal level of resistance on the move yesterday. and still above that. Still got some work to do on the S&P. On the Russell, we are kind of in an interesting situation where we got above our 200-day, but we're below a pretty important support, or I'm sorry, trend line resistance level. The Russell looks poised to break out from this level, and I think it will because small caps are still in a process of outperforming the mega caps, and value is outperforming growth. So that's something that I want to again have everybody be aware of. So I could totally see this going back up. And the Nasdaq still only above its 50-day moving average, got above an important horizontal support level. We still have the 100-day, the descending trend line, and the 200-day moving average to get above. So a lot more work to go on the Nasdaq, but again, because of what I just talked about, right now there are really no macro catalysts that are going to potentially put a block in the way of the markets melting up as far as equity markets. That's just the way I see it right now in the near term, not at least until early December. So December 2nd, we have non-farm payrolls. I could see that being a positive catalyst for markets. And then the CPI report doesn't happen until Tuesday, the 13th of December. And so a lot can happen until then. So what I'm expecting is kind of sideways to up. That's the bias, at least in the near term. And unless the macro changes, I mean, if the Fed, if CPI comes in below expectation again, and we don't see that mean reversion that I was referring to, then in that case, I could then the Fed pivot, pause, slow down narrative. That's going to be proven true. But again, the macro picture is cloudy until then. So if you're into it, you could take strategic positions in some of these assets. You want to be really careful about chasing. So obviously, you don't want to go into futures markets on Sunday night or the equity open on Monday and just start buying, hand over fist. You want to wait for pullbacks, small pullbacks that are going to help you manage your risk properly around very specific levels. So that's something I want to call out. Another big story of the week, in spite of all of the good news about inflation coming down, you have crypto down pretty significantly. So crypto, again, I'll pat myself on the back for saying that the June lows were not the lows. And after having consolidated sideways and not seeing new lows, even while equities did, Bitcoin finally did see new lows, and with all the FTX drama and like all these different exchanges are now pausing withdrawals. It looks really, really messy. Hopefully all you guys got out of your exchanges and put your coins on hardware wallets, because right now the waters are so murky. I mean, even like we have BlockFi at risk. We have, I can't even name all of the different places that are at risk. And there's some whispers that, if it gets bad enough that even MicroStrategy and Grayscale could be in trouble. And obviously that's just rumor right now. So I'm not trying to speculate, and I'm not trying to fear monger or anything like that. But I think those are risks that you have to be aware of. And be aware of trying to catch the falling knife here. A lot of people, just like back in the June lows and just like they did back in the May lows, they're calling bottom. And it's, again, hard to see without that significant shift in the macro. It's hard to see this being the bottom. And just, normally I reserve this for Twitter posts or premium subscribers to my newsletter, but I do want to call out my MRT. It's the multiplier reduction tool that I made for Bitcoin. Let me get rid of some of those lines. We came below yellow, back above yellow, and have retested yellow. We're basically in no man's land because we are between green and orange. I'm expecting to get down to orange. I've been saying this ever since I released this tool. I expect to get down below orange, and right now orange is at here we go, at 13,260. Um, and it could be a wick. It could be where we close below it and then roll around that level. I am expecting that. If we do get that, that's going to be like I'm going to say that that's as close to the bottom as you'll be able to call it. Um, or on the other hand, if we close above green, history shows that after we've crossed below uh, yellow and then closed above green, then that's usually the signal that the bottom has been put in. It's like the confirmation that the bottom is in, and that would be also an appropriate place to buy. And it's okay. I mean, right now you don't have to be in a rush to get in. There's a lot of money to be made. You don't have to be in a rush because like this green line is coming in at a little over 22,000. I mean, that's a pretty decent level to get in if we're talking about potentially the next 4 year halving cycle getting us over 100,000. I mean, the risk to reward is fantastic there. So you don't need to be in a rush. You don't need to try to catch the falling knife. And again, just like in the other markets, you don't need to be so concerned about trying to tap the exact bottom to make the maximum money off of that. Um, and then really quickly, gold. Well, we got solid breakout from gold, but to me, this is going to be exhausted really, really quickly. Again, I think a lot of this is people trying to front run the expectation of the turn in Fed policy. Otherwise, there's not really any reason for gold to be doing what it's doing. And again, if you missed it, then now is not the time to buy it. If you are interested in potentially shorting a mean reversion, because again, if we put back up our moving averages, um, the 50-day moving average is typically what you would see as far as mean reversion. We got way above that, above the 50, above the 100-day. The 200-day from a risk to reward standpoint, and and then also this horizontal level at 1807, which is where the 200-day moving average is right now, is going to be a great spot to manage risk if you're thinking about going back to the short side on it. I know that there are a lot of services out there that are calling out that not only gold, but gold miners are way, way overbought, and there's a lot of crowding into them on the long side. So that would be potentially an opportunity and a spot to pick. And then finally, crude oil. And then I've been recording for 30 minutes, so want to make sure we get out of here. Crude oil broke its trend line, which I've had up. I was wondering what was going to happen, so I just left it in preparation for this video this week. We did get back above it, so that'll be something interesting to watch. It looks like we're narrowing. Obviously, we've got kind of this triangle. If it breaks down from here, it's going to be super bearish. But then again, you could make the case that it already did break down and then it's up right back up in. That's pretty bullish usually if you get a fake breakdown like that. A lot of this is relating to potential SPR, like the ending of SPR releases and potentially buying back into the SPR to refill the SPR, I should say, and also on China reopening speculation. So you want to be careful, taking positions, because you don't want to just base your positions on pure speculation, because otherwise you'll get destroyed if this breaks back down. So, but it looks good right now, honestly, to me. We came above and retested the 50-day moving average successfully, and we're about to go for our second test of the 100-day moving average. If we can get back above that, that's going to be super bullish. And so I think it looks good, for now. That's just my opinion. And that's kind of the look at the markets. Again, I spent a lot of time talking about the dollar yields and then this inflation data. But I think it's important because I think you need to be aware of right now, like everyone's called dollar top. Everyone says this is it. This is the turn. This is the end of the dollar. Dollar's going to go back down. And it might, but you have to take into perspective the likely inflation data for next month. You can't expect that the rate of change is going to have that kind of multi-sigma deviation to the downside like it did on this report. You can't, and you have to be aware of how the Fed could respond to this. And to be honest with you, if the Fed wants to tighten financial conditions right now, this is not tightened financial conditions. And then add that to the fact that both the Fed's balance sheet, the Fed's balance sheet actually did increase. I believe I saw some information on that. I don't have it up. And then the Treasury General account is not where Janet Yellen said it was supposed to be, where she wants to end the year at as far as the Treasury General account is concerned. So right now there's a lot of excess liquidity that has not been removed for the system or from the system or has potentially been added back into the system. And I think you just have to be aware of those dynamics. If we're talking about the Fed looking to tighten financial conditions and the markets are bouncing and liquidity is actually going up uh, on an average basis right now, then really all we're seeing is another opportunity for the Fed um, to continue to tighten and have the cover to do so. So you just have to be aware and be prepared for the range of possible outcomes. And so just be really careful. Sorry that this video went really long. I hope you guys have a great weekend and good luck and have a safe weekend. I'll see you guys next week.